Alright guys, so we are officially in a clown economy. Just me making a video about inflation shows you how ridiculous things are. The US CPI report is out and the market stopped going down, it shot up instead. But here's the issue. If nothing fundamentally changes, this is likely a dead cat bounce or a sucker's rally. And if you're into sports or boxing, this is called a fake out. And you'll quickly understand why. Headline inflation in dark blue is actually trending up. It's up by 0.2% in November, printing 2.9% in December. This is important because food and energy is calculated here. The rising cost of living is actually getting worse. Core inflation, which is the focus here, fell to 2.9%, and that's the dotted line. Inflation is still very sticky in the US economy. We are at the same levels back in July 2024. The underlying situation hasn't really changed. So why did the stock market rise? Why are assets getting repriced higher after falling for 3 days straight? And it's all because of expectations. The market is trying to find an excuse to reverse the crash that wiped out all of December and January's gains. But it's not a strong enough argument. And here's how ridiculous things have gotten. All it took was for core inflation to print lower by 0.1% compared to estimates from Wall Street. That's all it took for the markets to shoot up and investors to pile back in. But this could be a very big mistake, and as we said, the overall inflation picture is still rising. This is the problem with fundamentals today, and if you spend time analyzing companies, you're probably losing your hair. You're gonna end up like me, bald and angry. Going through company balance sheets and calculating earnings, that's gonna be a dying art because no one cares anymore. Everything revolves around the Federal Reserve and what they're gonna do. If core inflation prints lower, the Federal Reserve is gonna cut rates, and if consumers they have lower rates, they will spend more. At least that's the general sentiment. A few days ago, major banks were predicting zero rate cuts in 2025, but the narrative has suddenly shifted out of the blue. In March, the market expects a 27% chance of a 25 basis points cut. This is just from the recent CPI report, and it gets crazier as we project longer into the future. Remember, everyone expected zero cuts in 2025, but by December, expectations have truly shifted. There's only a 18.3% chance of zero cuts. In other words, the odds of the Fed lowering rates has jumped to over 81%. Nearly half of traders believe two or more cuts are coming. Fed funds could hit down to 3.5% or even lower. Now, this sets up a very interesting dilemma. Now that the world expects lower rates, if the Fed, for whatever reason, doesn't cut, the next correction could get even more brutal. Investors they're setting up themselves for a big disappointment, which brings us to the discussion of inflation. Now, a big part of that is the price of energy because it feeds into the rest of the economy. Now, Trump has managed to get a ceasefire deal. Tensions in the Middle East have deflated somewhat, and that would mean oil prices should drop because, by extension, a few things could happen. The risk to oil producers like Saudi Arabia has dropped, but oil prices are not coming down fast enough. In fact, American crude prices are up, going well above $80 a barrel. So high energy prices have not been solved from the ceasefire. And why is this happening? Because US sanctions on Russian oil, they are starting to backfire in real time. And this is how interconnected global markets are. And here's what happened. Over the past week, the Biden administration took the oil sanctions to the next level. Over 270 tankers are banned from transporting Russian crude. As a result, 16 million barrels of supply is now compromised. This crude won't be flowing to the West. It will be transported to countries like China that are happy to buy barrels of oil at a deep discount. This is one example of a supply disruption that's causing energy prices to stay high in the West. As a result, headline inflation is not just staying sticky. As the report revealed, it's actually going up. You sanction a big oil producer, well, you're gonna get rising inflation. In today's economy, building multiple income streams is important. Reaching your audience with videos is simply essential. Invideo AI allows you to express and communicate your ideas in the form of stunning videos, the kind you have always wanted to create. Videos you'll be excited to share with your peers in the most seamless way possible, regardless of whatever skill level you are at. Just check out version 3.
I once watched my savings vanish to inflation's relentless tide. Then I discovered gold and stocks, havens against uncertainty. I educated myself, made calculated decisions. Slowly, my financial reality transformed. From rags to riches through the power of strategic investment.
Forget about traditional video tools with steep learning curves. They don't solve the entire video creation process. Invideo is the creative partner that you have always wanted that removes all friction. You can try Invideo AI for free, but if you want to use their generative capabilities, I recommend you go for the generative plan that starts at $96 a month. It gives you the most bang for the buck with 15 generative minutes. Save hundreds of dollars that you would otherwise spend on editing, animating, and other production costs. And if you're already an Invideo user, you can simply go to the add-on section and buy generative seconds. Check it out today. It's important we understand this. The geopolitical problems are far from over. I still believe over time the markets will continue to trend up, currencies will continue to lose value, and there will be a rising tide on everything, including asset prices. But the biggest crisis now is the US consumer under threat because that's nearly 70% of GDP. And what Trump plans to do with his tariff war could introduce a global shock, one that can take down the US consumer and drive inflation even higher. Now, as we all know, Trump is moving to slap tariffs on the world, up to 60% on China, 10% on the world at large, even 25% to allies like Canada. And the world is starting to respond. Here's what Canada's foreign minister has to say.
Now, we've gone through Trump 1.0 administration. We've gone through tariffs because he has imposed in the past tariffs on steel and aluminum. We had a strong response at the time. We did a dollar for dollar retaliation package, and we were very specific, very surgical how we were reacting. That's what we'll do. But at the same time, 25% on the entire Canadian economy is extremely important. So that's why we have to put everything on the table.
So even the Canadians are preparing. They are threatening to retaliate if Trump imposes his trade tariffs with their own set of punishments. And this will include import taxes on $105 billion worth of US goods. And this includes American cars, consumer goods, machinery, electronics, just to name a few. If the US sells less to Canada, this is going to impact the earnings of American companies, which would eventually hammer US jobs and salaries, crushing the US consumer directly. But let's also address the elephant in the room. Trump's tariffs might help reshore production back to US factories, but that's going to take many months and years to ramp up, if at all. Meanwhile, people will be hit with higher prices on goods from the world, not just Canada. Everything coming in from Asia, China, Europe, and the Middle East, they're going to fly up in price, and that's going to be very inflationary. Now, besides maple syrup, Canada is also a big exporter of oil to the US. Almost all of their crude is sold into the country. 87% alone comes from Alberta, and that's over 3 million barrels a day alone. And yes, the 25% tariff could hit oil exports as well. This means a resurgence of energy inflation could be coming, not from Russian sanctions, but a trade war with Canada. And what happened yesterday was just one inflation report, guys. It's a blip. And the market shooting up really shows us how desperate things are becoming. Any small excuse is now being used as ammunition to pile even more money in. But the fundamentals are not looking good. If Trump's trade war goes pedal to the metal, the Fed can't possibly cut rates in 2025. But let's just assume the Federal Reserve they cut rates this year. And let's say it's one or two cuts. It doesn't even change the picture when it comes to long-term interest rates. It is the 10-year yield that truly matters, that controls the cost of borrowing in mortgages, insurance payments, and credit card rates. And if that stays high, the underlying fundamentals continue to collapse. The current 10-year yield sits at 4.78%, and that's near the high of 4.8. This will have to drop in order to remove all the pressure on the US economy. When borrowing rates drop, companies can expand more and people tend to consume more. But let me ask you a question. What drives the 10-year yield? It's the demand and supply of US Treasury bonds. And what controls this supply? Who issues these bonds to the market for investors to buy? It's ultimately the US government itself. And here's the problem. In 2024, the government took in $4.92 trillion in receipts, and that's the column on the left. However, they spent $6.75 trillion. This means the US is running a deficit of 1.83 trillion. This is money that has to be borrowed into existence to keep the economy running. It's more than social security and double the budget for healthcare. Now sit back and think about all the reforms Trump wants. More likely than not, he'll be forced to borrow even more money. Trump wants to cut taxes and he wants to reshore industries. Now, fair enough. But that would jack up the national deficit. To pay for it, more bonds will have to be issued, and that's going to put upwards pressure on long term yields. Now, we know US deficits are only going to balloon, but in 2025, we could see the borrowing explode to new levels. Under his campaign promise, borrowing will have to rise tremendously. Firstly, the national debt would increase to 140% of GDP, and that's the average projection. But the problem here is the additional borrowing obligations. To balance the budget, the Trump admin will rack up a deficit of $7.7 trillion over the next 10 years. And that would mean issuing an average of 770 billion worth of bonds to the open market every single year. When you flood the market with such an amount of debt, it's dangerous. Yields could go even higher because investors would puke from the additional supply. And these are the fundamentals of the US economy and the global situation, and it all points to stubborn long term inflation. Now, the Fed wants to bring it down to their 2% target, right? But is that even realistic at this point? So, I don't want you to be hyped up over this one CPI report. Now, don't get me wrong, I'm happy that my stocks are up 1 or 2% from just a few days ago, but the underlying risks are still present here. Inflation is still a pressing problem, and according to the Fed, it's getting worse. Households expect their expenses to rise by a whopping 4.8% in 2025, and it's well above pre pandemic levels. At the same time, access to credit is also dropping, so calling for multiple cuts this year is still very premature. Now, in order for rate cuts, we're going to have to see successive CPI reports that show both core and headline inflation coming down. And until then, the markets would continue to stay very volatile. We'll be stuck in a limbo alternating between a collapse and prices flying up and then collapsing again and once again flying back up. But let me know what you think. Will the Fed cut rates in 2025? And if so, how many cuts will they do? Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.